At Warren Buffett's final shareholders meeting, a remarkable audience gathered: billionaires, CEOs, even political leaders, all eager to hear his insights one last time. For the first time, Warren Buffett spoke with complete clarity about his investment strategies, when he'd buy, what he'd target, and how he'd act in coming market cycles. This wasn't just another meeting, it signaled the end of an era and the unveiling of a financial strategy Warren Buffett had anticipated since 2003, one that now seems to mirror America's current moves. He's been patiently waiting for this moment to execute what may be the greatest financial play in history. What does it mean for us? Welcome to Stewardship Finance Academy. We are a channel to build confident investors. Recently, major billionaires like Gates, Zuckerberg, and Huang sold their stocks ahead of the global crash. But the real winner? Warren Buffett. Not only does he have the largest cash reserves ever, but he's also been positioned for major gains, especially through assets like the Japanese yen. But there's a twist. As US stocks rebounded, many expected Warren Buffett, with his massive $330 billion cash reserve, to buy in at the market's low. Yet instead of investing, he increased his cash holdings to $350 billion, choosing to remain on the sidelines. Why would he miss what looked like the perfect buying opportunity? At the recent meeting, Warren Buffett explained he almost spent $10 billion, but ultimately held back, unable to justify the investment. He pointed out that Berkshire's stock has dropped over 50% 3 times in the past, making the latest downturn seem minor by comparison. So, even with all that cash, Warren Buffett refuses to act unless true value appears. What he revealed next surprised everyone. At the meeting, Warren Buffett was asked how he'd handle US dollar depreciation. His blunt answer? He won't invest in a currency going to hell. More surprising. Warren Buffett plans to reduce his cash reserves from $350 billion to just $50 billion within 5 years. At first, this seems contradictory. Why hold so much cash if you think the dollar will drop? Why not invest now? The truth is, Warren Buffett believes the real crisis may not have happened yet, that this market rebound could be a false bottom. While others rush back in, Warren Buffett is patiently waiting for a true buying opportunity. What does this mean for you? It's a reminder to be cautious and think long-term, not just chase quick rebounds. Another headline from the meeting: Warren Buffett's criticism of U.S. policy, without naming names. He warned that trade wars and tariffs are isolating America, not helping it. But this isn't new. Back in 2003, Warren Buffett explained this with the story of 2 islands. Warren Buffett once used a simple metaphor to criticize U.S. fiscal and trade policy: Thriftville Island and Squanderville Island. Both islands started out self-sufficient, but Thriftville Island's people began working extra hours, trading their surplus to Squanderville Island in exchange for IOS. Over time, Thriftville Island accumulated so many IOS that they converted them into Squanderville Island's currency and bought up all its land. Suddenly, Squanderville Islanders had to pay rent to Thriftville Islanders just to live on their own land and keep working to pay off their debts, a loss of independence. Warren Buffett used this story to warn that the U.S., like Squanderville Island, has moved away from manufacturing and paid for imports by issuing debt to other countries. If this continues, foreign holders of U.S. debt could someday own American assets, forcing Americans to work just to service debts and pay rent. Warren Buffett's point: borrowing now could mean future generations lose economic freedom. He offered solutions to address the dangers of ongoing trade deficits and national debt. Warren Buffett once proposed a bold fix for America's trade imbalance: import licenses matched to exports. Under his system, U.S. companies that export goods would receive licenses equal to their export value. These licenses could be sold to importers, who could then use them to bring in foreign goods up to the value of total U.S. exports. This would make imports more expensive and direct some of the profit back to American exporters, like a built-in reward system. Essentially, every foreign company wanting to sell in America would have to buy a license from a U.S. exporter, keeping trade balanced. The policy is similar to tariffs, but, in Warren Buffett's view, less punitive and more like buying a ticket to participate in the U.S. market. In effect, Warren Buffett's system would cap imports to the value of exports, a 100% tariff, forcing perfect trade balance. While he's criticized tariffs for being aggressive and divisive, his proposal is actually stricter, but the difference lies in the perception. Taxes feel punitive, licenses feel transactional. Warren Buffett's famous Thriftville Island and Squanderville Island parable justified such measures, warning that endless borrowing could let foreigners buy up American assets. But does that reflect reality? Ironically, the U.S., as the world's reserve currency issuer, can print dollars to pay debts and even buy assets abroad. America isn't a colony of its creditors. Its unique position lets it sustain deficits and maintain influence. The U.S. sits at the heart of the global financial system. Unlike other countries, it issues debt in its own currencies. So when it needs to repay, it can just print more dollars. This gives America a massive advantage. In crises, U.S. capitalists often buy up distressed global assets at bargain prices, further expanding their influence. For example, Americans hold stakes in major Japanese and Korean firms. The reality is, instead of Thriftville nations buying out the U.S., It's often the reverse. America, with its financial leverage, acquires and dominates others. If you think working hard and saving will beat the system, think again. Capitalists can erode your savings through inflation and asset prices while acquiring assets themselves. The safe route, just working and saving, doesn't protect you. In fact, it can make you more vulnerable to being harvested by the system. While we lack Warren Buffett's resources, we have flexibility. We can follow trends set by large investors, entering and exiting quickly when needed. Successful investing isn't about being right every time. It's about making sure your wins are much bigger than your losses. For instance, even if you fail 99 times but hit one big win, you can still come out ahead. This strategy applies to all asset stocks, gold, crypto, or Forex. If you don't have a system yet, now's the time to learn. Our Stock Investment Masterclass is designed to teach you these strategies step by step, and for a limited time, you can join for free by clicking the link in the description. But don't wait. We're taking this offer down soon, and once it's gone, you'll lose access to these insights and benefits. America's financial dominance has evolved. Once, the Fed could fix downturns by cutting rates. But after the 2008 crisis, even zero rates weren't enough, so the Fed began quantitative easing, printing over $8 trillion by 2020. But this can't go on forever. As U.S. debt grows, other countries hesitate to buy treasuries. If America keeps printing money to pay debts, confidence in the dollar could collapse. By 2025, old tools like rate cuts and money printing may stop working, forcing the U.S. to find new solutions or face severe consequences. Historically, the U.S. relied on printing dollars to buy goods and services from the rest of the world. While other countries did the labor, those dollars were recycled as foreign countries bought U.S. Treasury bonds, creating a cycle in which Americans got to spend and the world kept lending. For decades, the U.S. could keep the system going by simply lowering interest rates and printing more money. But over time, other countries realized they were doing the work, while the U.S. got by with minimal effort, mainly paying interest. As a result, foreign appetite for U.S. debt began to decline, leaving America unable to borrow and spend as easily as before. When lowering interest rates and expanding the money supply stopped working, the U.S. had to find new ways to support its economy. Enter tariffs. Instead of relying on global creditors, tariffs let the U.S. reclaim wealth from abroad. Rather than depending on foreign lending, tariffs extract resources and value directly, redirecting global gains back to America. This marks a turning point. America has shifted from borrowing to a more aggressive, insular approach, no longer waiting for the world's help, but actively securing its own financial interests with tariffs and protectionist policies. With the dollar's future in question and tariffs rising, the real challenge is how the U.S. will navigate this new reality. It's one where it must adapt to survive without global financial support. Recent U.S. tariffs have contributed to the sharp depreciation of the dollar. Historically, foreign investors bought U.S. Treasury bonds lending money to America, which helped keep the dollar strong. But many bonds are maturing in 2025, forcing the U.S. to repay large sums. If foreign investors don't reinvest in U.S. bonds, they'll convert their dollars back to their own currencies. If the dollar has depreciated, their returns shrink. For example, an investor earning 1% to 2% annual interest might lose 10% on currency exchange, making treasury bonds unattractive. What are their options? 1. Stop buying U.S. bonds, accept the loss and look for other investments. 2. Keep buying, but at higher yields. With current U.S. Treasury yields around 4%, and the possibility of future rate cuts, investors may choose to lock in these higher rates, hoping the dollar rebounds over time. Tariffs, intentionally or not, help trap capital inside the U.S. They incentivize reinvestment in U.S. bonds and help avoid a debt crisis. If, however, investors abandon Treasury bonds, a financial crisis could result. In that case, the U.S. might let the system collapse temporarily. Print money to reboot the economy, and use the crisis for global advantage, a potential reset button for America's financial system. U.S. Treasury bonds are falling, and major investors like Warren Buffett are acting cautiously. Instead of buying during market lows, Warren Buffett has been selling bank and financial stocks, suggesting he expects a major crisis. What if the dollar keeps dropping as much as 10%, 20%, or even 30%? If that happens, global investors in U.S. assets would face big losses not only from falling values, but also from a weak dollar. Trying to exit these investments could make losses even worse due to poor exchange rates. Meanwhile, falling asset prices attract American buyers who can scoop up bargains, while foreign investors are stuck with losses. With both the U.S. stock market and dollar declining, new foreign investment dries up. Nobody wants to buy into a market that's collapsing. Foreign capital gets trapped, while domestic giants like Warren Buffett can ride out the turmoil or buy assets cheaply. Notably, though Warren Buffett now holds about $350 billion in assets, 25%, in cash, most of his wealth remains in U.S. assets, signaling confidence he can survive or even benefit from market upheaval. Most of Warren Buffett's investments aren't in publicly traded stocks. Less than a quarter of his U.S. assets are in the stock market, mostly in strong Dividend-paying companies like American Express and Coca-Cola firms unlikely to fail in a crisis. For Warren Buffett, steady dividends matter more than stock prices. A large share of his wealth is in privately owned businesses which aren't exposed to daily market swings. So, even if the stock market crashes, Warren Buffett's portfolio would be less affected, unless there's a total collapse of the US economy or his specific companies. What if the dollar goes to hell? Doesn't become worthless. It just loses value relative to other currencies. This has little impact on Warren Buffett, because he invests and spends almost entirely within the US for him. As long as his dollars circulate domestically and buy American goods and services, his wealth is secured, just like someone earning and spending only yen in Japan is mostly insulated from global currency shifts. Warren Buffett's strategy shines during downturns. With significant cash reserves and private holdings, he can buy undervalued assets when markets crash, just as he did in 2008. His investments in resilient companies and private businesses also continue to provide steady returns through dividends and operations. Small shifts in currency markets like the $8 billion that moved the Taiwan's dollar show how sensitive global flows can be. Yet for Warren Buffett, whose fortune is anchored in the US, switching to other currencies isn't practical. Moving hundreds of billions would itself destabilize the dollar. If the dollar depreciates significantly, Warren Buffett can't exit or short the US's capital is effectively trapped in American assets. Even his rare overseas investments, like in Japan, are funded through local currency borrowing, not dollar conversion. Ultimately, Warren Buffett's wealth is tied to the health of the US economy. This leaves him exposed to domestic risks, but also positions him to buy distressed US assets cheaply and benefit from an eventual recovery. In a crisis that traps foreign capital in US assets and halts new international inflows, Warren Buffett stands to gain. Unlike global investors who could face steep losses from falling asset values and a weaker dollar, Warren Buffett's money stays insulated and focused on American opportunities. He signaled his strategy. Warren Buffett plans to reduce his huge cash holdings from $350 billion to $50 billion over 5 years, keeping only what's needed for operations. This suggests he expects a major buying opportunity soon, likely before the end of Trump's term. Warren Buffett sees the current market not as a true bear market, but as a prelude to bigger opportunities. His total exit from bank and financial stocks shows he expects these sectors to be hardest hit if the dollar keeps dropping. By 2030, Warren Buffett plans to finish his bottom fishing and focus only on US assets, anticipating a post-2030 surge in their value. His approach is patient. He's waiting for crisis-driven bargains, not quick rebounds, trusting in the long-term recovery of American markets. Warren Buffett's approach is shaped by his massive scale. He can't spread his capital thin, so he hedges with short-term US treasuries and waits for prime opportunities. Individual investors, in contrast, often seek diversification in safe-haven assets like gold, Bitcoin, yen, or Hong Kong stocks to hedge against dollar risk. For individuals, the main goal is protecting existing wealth. Choosing assets that outpace dollar depreciation helps preserve purchasing power. However, many are piling back into US stocks after recent rebounds, exposing themselves to risks from both potential market drops and a declining dollar. Take a Japanese investor. Buying Japanese stocks only risks share price dips. But buying US stocks adds currency risk. If the dollar weakens, any gains can vanish when converting back to yen. In a severe crisis, early entrants chasing rebounds may suffer the most. My personal strategy since late last year: avoid unnecessary risks instead of chasing quick profits. Real wealth comes from bull markets, not gambling during uncertainty. Align your investments with your principles, understand your methods, and focus on building long-term wealth without undue stress. If you haven't joined my free investment masterclass, now is the time. Learning sound investment principles can help you navigate uncertainty and build lasting wealth, no matter what the market does next. The financial climate is increasingly volatile and changing fast. We are committed to sharing free videos every week covering financial freedom, entrepreneurship, and investing. Subscribe and turn on notifications so you never miss an update, and share these insights with friends and family. To everyone who's liked, subscribed, or commented, thank you. Your support motivates me, and I wish you all financial success. If you have questions or feedback, please leave a comment. I love hearing from you. If even one idea from today's video helps you, I'm satisfied. My goal is to empower you with knowledge and inspiration to reach your goals. Take care and see you in the next video.